I'm Grant Mundell, Investment Specialist at Equity Trustees with the August Monthly Market Review. August experienced heightened levels of volatility, but equities and bonds broadly ended the month higher in local currency terms. The month started with equity markets selling off aggressively following softer US employment data, along with hawkish comments out of the Bank of Japan, which triggered a sharp unwind of the carry trade, where investors have effectively borrowed in a low interest rate environment, such as Japan, and invested in a high interest rate market, such as the US. The unwind reverberated across many different asset classes, and equity volatility spiked higher and bond yields fell aggressively as investors sought the safety of bonds and priced in synchronized central bank rate cuts. However, equity market concerns were quickly alleviated as stronger US economic data was delivered, and the Bank of Japan signaled they wouldn't hike rates until market stability was restored. And then later, the US Federal Reserve all but confirmed rate cuts would be delivered in the short term. This led to a reversal in market fortunes, with equities rallying over the balance of the month, while bonds held on to much of their gains. The US Federal Reserve comments saw markets cement their expectations that rates will be cut from September and priced in around 7 rate cuts over the next year. The RBA, on the other hand, pushed back on any near-term rate cuts. This saw the Aussie dollar appreciate 3.4% against the US greenback. US rate cut expectations continued to support the gold price, which has been a standout commodity exposure over the last year. Stock volatility was also prevalent during the month as analysts pored over company results. Overall, FY24 results were reasonable versus expectations both in Australia and the US, despite ongoing cost pressures. However, outlook statements remain somewhat cautious in Australia, leading analysts to downgrade their earnings expectations for FY25. Major banks delivered resilient numbers versus expectations, underpinning their recent outperformance in the market, especially relative to resource stocks, which have been impacted by a slowing Chinese economy and a soggy real estate market. We continue to advise our clients to be appropriately diversified and believe our active and disciplined quality at a reasonable price approach is well suited to the current market conditions. While international equities are forecast to deliver around 12% earnings growth in FY25, growth in the ASX 200 is forecast to be more subdued at around 4%. However, both international and Australian equities are trading expensive relative to historic levels, so their earnings forecasts need to be delivered. Interestingly, the US market is starting to see a broadening of returns outside the Magnificent Seven. As investors look for mispriced stocks that are leveraged to lower interest costs and a rebound in future economic growth.